Okay, last week we looked at ways to control risk by using a stop loss. Today we're actually going to look at very simple idea for getting into the market. This is a raw price chart of the Dow Jones Mini Futures contract for YM. It's clearly in an uptrend, but we need some ideas on how to actually get into this market rather than just buying blindly here and getting stopped out because we were buying the top. We want to have some kind of confirmation of when the price is moving in our favour. And one very, very simple old idea is to use a moving average. A moving average is quite simply an average of the last X number of bars divided by that number of bars. So supposing you want a 5-period moving average, you take the price of the last 5 bars, add it together and divide by 5, then you get the average of those 5 prices. You plot that on the chart and move on to the next 5 bars and so on. A slightly more sophisticated kind of moving average is called an exponential moving average, or an EMA, and this uses a mathematical formula to hug the price a little bit more accurately, and these are the moving averages I prefer to look at. So let's add one to this chart and see what it does for us. We're going to add a 20-period moving average to start off with and see what that does. Well, here you see the blue line, and how could we use that to enter trades? Well, we might decide that if price is above the blue line, it's in an uptrend, so we're going to buy pullbacks to that blue line. So maybe here would be a nice entry, that would have been a nice entry, that would be a nice entry, and so on. When it's closing below the blue line, we're not interested in longs anymore, we're interested in short trades. When it closes back above, we can start looking at long trades again. But perhaps we can do better with 2 moving averages, so that's what we'll try now. We're going to add a 5-period moving average here. Whoops. I'll try it again. And now you've got a shorter period and a longer period together, and the idea here is that you take your trade when the 2 cross over. So we're going to take a trade here, and we could have taken a short trade here. We could have, let's back up a bit. We could have taken a trade here. We would have taken a short trade here, and these are all, decent setups. The problem with moving averages is that when prices are choppy, you get a lot of false signals. So in a trending market, even there and here, we've got good setups. This, however, is messy. You don't want to buy there. You don't really want to buy there. You don't want to buy there. Selling there was nice, however. So how can we get around this? Well, one way is to use yet another moving average of a longer period to act as a filter. And here we might decide we are only going to take trades in the direction of the longer term moving average. We could come up with all kinds of ideas for this. If this is tilting down, we only take short trades. If it's tilting up, we only take long trades. Maybe if price is below the moving average, we only take short, and if it's above, we only consider long trades. Maybe if the 20-period moving average crosses through the magenta, through the 50 period, then we're happy to take long trades then, and vice versa. You can come up with all kinds of filters to help you with this. The fact is, there are lots and lots of ways of approaching the market using all kinds of technical indicators. This is one of the simplest that you can consider in order to start looking for patterns that can help you to enter the market profitably.